The rich don't just earn more, they invest differently. In an era of economic uncertainty and rapid technological change, the ultra-wealthy are pivoting to a new blueprint for growth, one that prioritizes inflation-proof income, exponential innovation, and radical diversification. The best part? This strategy is no longer a complete secret. Here are the top 10 assets that high-net-worth individuals are betting on in 2025. These are assets once acquired can change your financial status and create generation wealth for your family for many years to come. 1. Public equities, stocks. When you buy a stock, you're purchasing a small piece of ownership in a publicly traded company. It's no surprise, then, that public equities remain the single largest allocation in wealthy portfolios, with an average of 47% of their investments. This significant weighting is a testament to the stock market's historical track record of delivering returns that outpace most other asset classes, making it a powerful engine for long-term capital appreciation. Investors can approach equities in several ways. Buying individual stocks offers high reward potential, but also concentrated risk. For broader, more stable growth, many turn to index funds and exchange-traded funds, or ETFs. These instruments bundle hundreds of stocks, offering instant diversification by tracking an entire market index like the S&P 500. Investors also strategically focus on high-growth sectors like technology and AI, fueled by innovation and consumer discretionary, which thrives on strong economic activity. And the performance has been compelling. As of July 2025, the S&P 500 has posted a strong 8.6% year-to-date increase. But it's crucial to understand the risk. Markets are inherently volatile, influenced by economic data, interest rate policy, and geopolitical events. History teaches us that market corrections are inevitable, yet it also shows that for disciplined, long-term investors, these periods have historically represented opportunities, with markets always recovering to new highs over time. So why are stocks a cornerstone for wealth accumulation? 3 reasons stand out. First, liquidity. Stocks can be converted to cash within days, offering flexibility other assets can't match. Second, unparalleled growth potential, fueled by innovation and the magic of compounding returns. And third, accessibility, thanks to low-cost online brokerage platforms. Looking forward, global trends point towards opportunities in emerging markets and disruptive sectors like clean energy and biotechnology, ensuring equities will remain an essential component of any serious investment strategy. 2. Private equity. Coming in at number 2 is private equity, a cornerstone for sophisticated portfolios. This asset class represents capital invested in companies that are not publicly traded on a stock exchange. For the ultra-wealthy, it's a significant slice of the pie, with family offices dedicating, on average, about 15% of their assets to these private market opportunities. Private equity isn't a monolith. It spans a spectrum of strategies. There's venture capital, which fuels early-stage high-potential startups. Then you have growth equity, which helps more mature companies scale their operations. And finally, leveraged buyouts or LBOs, where firms acquire established companies, often using significant debt, with the goal of restructuring and improving them before a profitable exit. So, what's the powerful allure? The primary driver is the potential for superior returns. Private equity has historically outperformed public markets, partly due to the illiquidity premium, a reward for tying up capital for longer periods. Investors also gain direct access to groundbreaking companies and disruptive technologies long before they hit the public market, capturing value at the ground floor. The current landscape is nuanced. Despite a slight reduction in allocation compared to previous years, a remarkable 39% of family offices are planning to increase their private equity investments over the next year. This signals a strong belief in long-term value creation and the unique opportunities that can arise during periods of market uncertainty. However, this potential for high reward comes with significant risks. Private equity is notoriously illiquid. Investments are often locked up for 7 to 10 years or more. The barrier to entry is also incredibly high, with substantial minimum investment requirements. Furthermore, unlike public companies, private firms have fewer disclosure requirements, leading to less transparency. Looking ahead, the future of private equity is being shaped by major global trends. We're seeing a surge of capital flowing into sectors like artificial intelligence, sustainable technology, and digital healthcare. There's also a growing movement towards the democratization of the asset class, with new platforms emerging to provide access to a broader base of accredited investors. For those with a long-term horizon and a high tolerance for risk, private equity remains a powerful engine for wealth generation. Coming in at number 3, we have real estate, a cornerstone of wealth for centuries. On average, real estate constitutes a significant 17% of high net worth portfolios. This extends far beyond a primary residence, encompassing a diverse range of assets. Investments include luxury residential properties and multifamily apartment buildings generating rental income. On the commercial side, this includes office buildings, retail spaces, and crucially, the industrial warehouses fueling e-commerce. For investors seeking liquidity, real estate investment trusts, or REITs, provide access to large-scale property portfolios, trading on exchanges just like stocks. The appeal of this tangible asset is undeniable. A striking 44% of family offices plan to increase their real estate investments, seeking stability in a volatile world. The focus is on future-proof sectors. Industrial assets are booming thanks to the logistics demands of online retail. Meanwhile, data centers, the physical infrastructure of the digital economy, are becoming a prized asset class, powered by the growth of cloud computing and AI. This is the new frontier of property investment. The why is multifaceted. Real estate offers steady income from leases, long-term appreciation potential, and a powerful hedge against inflation as rents and values rise. It's a tangible asset you can see and touch. However, it's not without risk. The asset class is illiquid, subject to market cycles, and can be management-intensive. Sophisticated investors mitigate this through diversification across property types and regions, and by leveraging professional management to handle the operational complexities, ensuring the asset works for them, not the other way around. Alternative investments details. This category, 8% of portfolios, includes private credit, hedge funds, commodities, and cryptocurrencies. Private credit is gaining traction due to higher yields, while commodities like gold and oil serve as inflation hedges. Crypto adoption is rising, especially among younger investors. Why? Diversification and non-correlation with traditional markets. Cash and cash equivalents. Details. Cash holdings, for example, high-yield savings accounts, money market funds, make up about 8% of portfolios. With interest rates still relatively high, these assets offer safety and liquidity, yielding 4-5% without significant risk. Why? Risk mitigation and short-term flexibility. 6. Bonds and fixed income details. Although bonds represent a smaller portion, less than 10% on average, corporate bonds and government bonds are used for stability. High-yield bonds, junk bonds, offer higher returns but come with increased risk. Why? Income generation and portfolio ballast during market volatility. A7. Renewable energy investments in solar, wind, and other renewable energy sectors are growing. Companies like NextEra Energy and First Solar are popular choices, often accessed via ETFs or direct investments. Why? Long-term growth potential driven by global sustainability trends and government incentives. 8. Technology and AI-themed assets. Thematic ETFs and stocks focused on AI, technology, and disruptive innovation are popular. For example, the RK Innovation ETF, RKK, has seen significant gains. Why? Exposure to high-growth sectors and technological advancements. Precious metals. Details. Gold and silver are held as safe haven assets, especially during economic uncertainty. Gold ETFs like Spider Gold Shares, GLD, have outperformed the S&P 500 in 2025. Why? Inflation hedge and portfolio diversification. Emerging market equities details. Investments in emerging markets, for example, via Vanguard FTSE Emerging Markets ETF, offer growth opportunities, particularly in Chinese equities and technology sectors. Why? Higher growth potential compared to developed markets. Key trends. Generational divide. Younger wealthy investors under 35 are more likely to invest in crypto, 9% allocation, and private equity, while older investors focus on bonds and real estate. Geographic diversification. HNWIs are spreading investments across regions to mitigate geopolitical risks. ESG and sustainability. Investments in renewable energy and ESG-compliant assets are rising. For more detailed insights, you can refer to sources like the 2025 High Net Worth Asset Allocation Report and the Wealth Report 2025. Clean infographic pie chart revealing all 10 asset classes and their allocations in a polished final summary. If you enjoy this video, then watch our next video on how to build financial wealth.